Hi, my name is George Stagnino. I'm the editor and publisher of the Peter Dack Portfolio. The purpose of this video is to look at the current trends in the business cycle and see how the business cycle relates to market peaks and bottoms. Not only that, but the business cycle can also give important, very crucial information on what kind of investment strategy you should follow, what kind of assets you should have, and how you transition from one type of assets to another. So this is what I'd like to cover on this video. The reason the business cycle moves from one stage to another is because business executives make tough decisions based on what is given to them from the Fed and from the government. They have to make decisions. So what are these decisions and how do they affect the market? Well, let's go start from phase one. Phase one is the stage where business has inventories and sales under control. Sales start increasing a little bit. So what you do when you have to increase production? Well, you need raw materials, so you're bidding up raw material prices. You need borrowing. You have to need money for working capital, so you're just borrowing short term and long term in case you need to expand capacity. And then you have to hire people, and therefore you have already a pressure on employment, and also people make more money, so they buy more goods. So you have to produce more, you have to put more in inventories, you have to borrow more, you have to buy more raw materials, and so as the process feeds on itself, the business cycle moves from phase one into phase two. Now, the crucial point is this one. This is one and this is two. This one is the most crucial one. What happens at the end of the phase two? At the end of phase two, there is a most important feature is commodities are rising, interest rates are rising, and inflation is rising with the economy growing, and that's crucial, above its growth potential, which right now for the U.S. economy is 1.5% to 2%. So why is that? You got to watch that. Well, because when inflation rises, what happens to your purchasing power? It declines. So you start buying fewer goods. But business at the beginning doesn't trust that, doesn't believe that. So they keep on producing what they always produce and put stuff in inventories. At some point, though, somewhere in phase three, they recognize they have too much inventories relative to sales. Why do they recognize that? Because they're hitting the PRL. They start losing money because they have too much inventories. So how does business react then to this? The common sense says you got to start producing more and cut prices. So cutting prices, reducing inflation. And produce more, what does it do? You reduce the purchases of raw materials. You borrow less, so you have less pressure on interest rates. And then, of course, you lay off people, and then maybe you fire people. And therefore, that reduces the wages, increase in wages. So, and this process continues until when? See, this is the way there was going up was a self-feeding process. Now the process self-feeds on the downside. Could be a recession or no recession, really doesn't matter. From the market's viewpoint, they react exactly the same way. Commodities, interest rates, and wages slow down, and inflation slows down. Until when? Until inventories are brought here in line with sales. At that point, they start producing again because there is always an underlying demand. And so the process starts all over again. As I said, the crucial part is this one, because this is where market is not a market top. That's very important. That's where the structure of the market changes, where the most successful investment change. Let me show you. In order to keep track of the business cycle on a real-time basis, what I did, I developed this graph. This graph shows exactly the turning points of the business cycle, exactly. And when it rises, the graph rises. This means the economy is strengthening. And when the graph declines, it means the economy is weakening. This is computed every second using market data. Now, what I'm saying is that this is when the phase one starts. This is when phase two starts. This is phase three, and this is the end of phase four. So this is the growth phase, and this is the weakening phase. By the way, I have a video when this was at this point last year. It's called "The Danger of Linear Thinking." Is that everybody was expecting a recession during this downtrend, but instead, what happened? There was something that was happening. So people were doing linear thinking, but I said, wait a minute, there is a turning point. And then I had a series of videos that followed on that idea. You may want to see because that's a real-time application of the concept. But so what you will see, since this is the strong phase of the business cycle, this is the strong phase of the business cycle, this means that the growth stocks are performing. Now, when this happens, when we are here at the peak, I will show you later the meaning on the implication. But the interesting part of this graph, there is another important application that from peak to peak is exactly 4 years, more or less. So since from here to here is 4, it tells you that this could be the real peak. And the next 4, the bottom, it will be 4 years from here. So this is another interesting application. But let's see now how the markets, the sectors, perform during the phases of the business cycle. But before we get to the sectors, what I want to show you that the economy is strengthening. That's important. So the indicator that I showed you before is correct. And in fact, this is the leading economic indicator of the conference board. By the way, do you see these turning curves here, the turning point? That's exactly coincide with the market indicators that I showed you before. It's simply amazing. They come with those curves using economic data. I come with the same curve using market data, and it's fascinating to me. Anyway, what this leading indicators is saying is turning up, and every time it turns up, it means the economy is strengthening. It's likely to continue to strengthen. This chart really shows what is really going on, and people somehow don't look at it, and they're still saying there is a recession. This chart has been showing for some time that income is growing at roughly 1.5 after inflation is going at 1.5%, and spending is going at 1.5%. And this is exactly what I think is the long-term trend right now of the economy, between 1.5 and 2%. So people are making money, people are spending, and the business cycle is going up, or at least has been going up. This is a very important chart that made me say, if you follow me on Twitter or my video, let me say the right things in the past. What does it show? It shows the increase in liquidity. That's the blue line, which bottomed in at the end of 21, beginning of 22, and has been rising ever since. And the green line is the producer prices of commodities. Now, liquidity leads prices, commodities, and inflation by roughly a year and a half. Okay, and what you see right now is that, and of course, where did this come from? The huge spending of the government. There's no doubt about that. I've been saying, by the way, this long time ago. But if you see the liquidity is increasing, and after a year and a half, PPI of commodities went up. Then liquidity came down, and a year and a half, commodities producer prices came down. Now, look at what is happening. It's been growing quite a bit, and what is happening to commodities is they are rising. And this is very important. And it's, by the way, one of the reasons why also the stock market has been going up. But let me show you more. This is the same graph for liquidity, the green line, and it shows that it's now growing at 10.8%. And inflation. Look at the liquidity is rising, and after a year and a half, inflation is rising. Liquidity is declining, and after a year and a half, inflation is declining. Now, liquidity has been rising now for a year and a half, about, and look what's happening to inflation. So this is bad news, because inflation, the best you can say, cannot decline. The odds are that will move up, continue to move up. And when will decline? Well, if history is any lesson, liquidity has to decline quite a bit, and for a long time, roughly a year and a half, for inflation to decline. So definitely we are on the wrong path to control inflation. And the Fed can say anything they want, but this is what the data are saying. So with the economy strengthening and going from phase one into phase two, you should not be surprised to see everything, commodities going up, everything, agriculturals, lumber is a little on the weak side, but oil, all the other metals are strong, everything is strong. So this is what happens when the economy is strengthening and moves from phase one to phase two. Commodities bottom and then go up. So this is the environment, that current environment, and these are the trends. So how does the business cycle relate to the stock market? Well, obviously you can see these are the peaks, the turning points in the business cycle is very important. Look at this peak. The market has not done anything for some time. This is a peak. The market has not done anything for quite a bit of time. This is a peak. The market has not done anything for some time. This is where we are. Is this the same situation? Chances are it is. But there is a strategic way of looking at this. It's not a buy or sell. This is an important thing for those you guys who follow me. This is not a buy-sell indicator. This is an indicator that tells you, look, we are here and it's turning up. You better start investing, increase your investing in the cyclical stocks. And this one says, look, I'm not sure if this will continue to decline. However, history shows that we are close to a period where the structure of the market changes. So maybe the portfolio should now be shifting from aggressive to more defensive sector. Now, is this right? Well, let's see what the evidence says. These are the 11 sectors of the S&P 500, and they are, the interval of time goes from the bottom of the business cycle, the last bottom, to the current current position. As you can see on the upswing, if you look at all the stocks that have been the strongest, they're all cyclical stocks. They are financials, they are commodities, they are industrials. So all those, of course, technology, of course, energy, because it's also a commodity. So you have the strong cyclical sectors. The weakest one have been healthcare, utilities, staples, the ones that are not shining. But then, when they will shine on the downside of the business cycle, and most likely bonds as well. Now, let's see now, I want to show you also another thing, how interest rates behave relative to stocks, because that's important to know. This graph, this schematics shows how interest rates behave relative to the stock market. And you have to think about the business cycle. The business cycle in phase one, here's phase one. And when they start rising is phase two. When they go here, they're beginning to be phase three. And this is where you find this. Then the stock market will decline until interest rates top, and they start declining. At that point, the stock market goes up because business is making more money. There is an interesting statistics that you may want to remember, that if, again, this is a big if there is a recession, now in short-term interest rates, as I showed you, they are rising. If there is a recession, the stock market will probably decline around 40%. But what is important to the short-term interest rates, I went back all the way to the 60s. From the peak of their interest rates to the bottom of phase one, they will decline at least 400 basis points. In other words, if interest rates, let's say, short-term rates go to 5.5%, they will decline to 1.5%. This is the history. I mean, from the peak to the bottom of the cycle. So this is something to keep in mind. Again, watch for this relation, because interest rates will decline only after there is a protracted decline in the stock market. Usually that's the history. Here I showed you a little bit of interval between here and here. They're much closer than showed in here. But anyway, this is the cyclical relationship. As you know, I publish the Peter Dack portfolio. You can find it here at www.peterdack.com. This book had really great reviews. I'm very proud of it. Is the title, I'm not sure if that's the right title, but McGraw-Hill Education asked me after they reviewed my website, they said, why don't you write a book? And since I was teaching the subject on an MBA program, I took my notes and wrote a book. People seem to, my students and people reading it seem to like it. I also wrote 2 more books, Easy Ways to Beat the Market with ETF. It is an analysis of moving averages and how they perform. And then investing wisely, it's easier than you think. Thank you very much for reviewing this video. I really appreciate it. And please do subscribe to this channel. It helps me my standing with YouTube and all the other subscribers. Okay. Thank you very much, and I hope to see you really, really soon. So long.